Now there's a pullback. Your cost structure is kind of set up for a goal that is kind of no longer achievable. You can't just raise the money as easily, or if you can, it comes at a high cost. How do you shift your focus? Because you're moving from a company that was valued and was just thought about it just in terms of growth. I'm a high flying startup company. I'm growing so fast, my valuation is increasing exponentially due to that growth. Now I've got to cut back because capital is harder to come by, and I'm worried about that growth story going away. How do I manage that process and manage the kind of expectations associated with that, both for my employees and for my investors?
Well, let me start with the investors. The metrics that investors a year or two ago would have invested at a certain valuation based on a certain revenue growth rate and size and profit margin. And those metrics have completely changed. So it's not helpful to say, what was it 2 years ago and what is it today as a percentage of 2 years ago? You should just forget about 2 years ago. Two years ago could have been 200 years ago. It's just irrelevant. The question is, what are the metrics now? And if you already have investors, that's a very important question for you to ask. So if I were the CEO or the CFO of a company today, I would meet with my investor privately and I would say, here's where we are. We may raise, let's say in a year, what revenue, profitability, revenue growth rate, CAC payback, net renewal rate do I have to achieve for you to be interested at any valuation a year from now? And if you're interested, what do you think the valuation is going to be, assuming the market a year from now is the same as the market today? And if the investor is a good investor, they will tell you. They'll say, well, you have to cut your burn from $1 million a month to $500,000 a month or some other number. And you have to get your CAC payback down from 3 years to 18 months or something like that. So part of it is a change in the capital markets, but part of it is a worsening in the actual underlying economics of the business. So if you were growing at 100% a year before and you had 10 salespeople, and now you went out, you hired 10 more salespeople and your growth rate is half, your productivity per salesperson just fell by a quarter because they're adding half the revenue for twice as many people. And so if you used to have an 18-month CAC payback, meaning I spend $1 on sales and marketing and I earn that dollar back just to cover my sales and marketing costs, not to cover my R&D or G&A costs. If I earn that back in 18 months, but now I've gotten 4x worse. Now I've gone from 18 months to 6 years. The economics have gotten terrible. So it's not just that the stock market went down. It's that your personal economics at your company got terrible. And basically what you have to do is figure out how to get better. So you probably need fewer salespeople and better, more sales effective strategy. And part of it is doing more with less. And part of it is figuring out a way that if customers are having longer sales cycle and less likely to buy, you should have a different go-to-market approach.